Today we will take a close look at Walmart and understand why I rate it as a strong sell. In my eyes, the company has become greatly overvalued mainly due to its low beta of 0.53 and historical stability, which in the recent unsteady markets attracted vast amounts of investors who inflated the stock price. In this analysis, we will go through the company's current market situation, as well as analyze its long-term fundamentals and finally calculate its intrinsic value using 4 of our intrinsic value models. Now, before getting into the fundamentals of the company and explaining its overvaluation, let's take a look at some positives. Something I do want to clarify beforehand is that I find Walmart a really great business with a good outlook and potential, but that doesn't mean I'm willing to pay 46.23 times free cash flow or 35.68 times earnings. It did greatly outperform the market in the past year, rising by 39.92% compared to the rise of only 8.13% of the S&P 500, but again, in my eyes, this growth is mostly accounted for by the company's artificially inflated value, and therefore it doesn't at all change my perspective. Now, foremost, something I love is that Walmart has been shifting to e-commerce space, with sales growing by 27% in 2024, accounting for 18% of the company's total revenue. To put this into perspective, online sales have grown from 13.80 billion in 2017 to 73 billion in 2023, showing just how much this segment has grown. In my eyes, building an e-commerce infrastructure is extremely important, as in the future, as people get more and more used to ordering from the comfort of their home and getting products delivered to their doorstep, I expect that e-commerce sales will top physical sales. On the screen you can see a graph pointing out the total percentage of online retail sales in the US, rising from 8.90% in 2017 to 15.10% in 2022, growing at a CAGR of 10.48%. Now, into the future, this trend is expected not to only continue, but to accelerate, with the worldwide online sales growing from $16.29 trillion in 2023 to $75.12 trillion in 2034, accounting for a CAGR of 15.95%. Therefore, I find it a great investment into the future that Walmart has been pushing free cash flow into e-commerce storage and delivery infrastructure. Over the past 5 years, Walmart's revenue has been growing quite decently at a CAGR of 4.05% from 559 billion in 2020 to 680.99 billion in 2024. This is some very decent growth for a company in a low growth sector such as Walmart. But already here we can see a concern for overvaluation. If you remember, the company's stock price has grown by 39.92% year over year, which certainly isn't supported by an average year-over-year revenue growth of below 5%. But let's move on further to the net income, which has grown from 13.51 billion in 2020 to 19.44 billion in 2024, accounting for a high CAGR of 8.95%. Although this is an outstanding CAGR for the company, again, it doesn't fully support the 2024 price rally. Finally, let's look at my favorite metric, the free cash flow. This is actually where a large part of my concern lies, as although the company has been growing their net income really well, their free cash flow, which is used for paying down debt, paying out dividends, innovation, etc., has been decreasing at a 5-year CAGR of 9.75% from 25.81 billion in 2020 to 12.66 billion in 2024. My sentiment is also supported by the 10-year free cash flow CAGR sitting at negative 4.94%, moving from 16.13 billion in 2015 to 9.63 billion in 2024. So overall, the financials wouldn't be looking bad at all if it weren't for the negative free cash flow CAGR, which in the future might very well put the company's well-regarded dividend king status at risk. Now, moving forward, let's take a look at the valuation, starting with the 5-year PE ratio, which is sitting at 25.91, not much higher than the 22.50 average stock PE. This would be great, but the issue is that currently, with the large hike in price, the PE is sitting at 35.68, which in my eyes is extremely high for a company in a low growth sector such as Walmart. Now, regarding the company's price to free cash flow, that as can be expected, with the decreasing free cash flow is even worse, currently sitting at 46.23 compared to the 5-year average of 24.70. So overall, both of these metrics hint that for most of the past 5 years, even though slightly overvalued, the price of the company might have been bearable, but currently, after 2024, it is, in my opinion, overvalued. Now, as Walmart is a well-regarded dividend king, it would be unfair not to look at its dividends, as they make up a large part of the company's value. Looking at their 5-year CAGR, though it isn't looking too great, as it's sitting at only 3.67%. The company's dividend yield also isn't too attractive, sitting at 1.09%, one of the lowest rates it has been at over the past 10 years, which again to me hints that the company is overvalued as their stock price growth has overtaken their free cash flow growth and therefore their ability to increase their dividends consistently. The good news is that even with their decreasing free cash flow, the company's 5-year free cash flow payout ratio is sitting below 50% at 40.72%, showing that their dividends are safe and that they would have the capacity to raise them considerably, but other important activities such as innovation or share buybacks seem to currently be the priority, leaving the free cash flow for dividend raises depleted. Now, as always, before summing up the 9 pillars, let's consider Walmart's debt levels and see if they are manageable. Their long-term liabilities over the 5-year free cash flow negative dividends ratio is sitting at 1.69, meaning that the $66.55 billion in long-term liabilities would be payable off within 8.5 years of the company's 5-year free cash flow, meaning that currently their debt is nothing to worry about unless their free cash flow generating capabilities decrease considerably within the coming years. Overall, as I said at the start, the company's fundamentals are looking really healthy. This is of course apart from their valuation, which we will dig into now. Firstly, looking to the Grams formula revised, I will plug in the high EPS growth at 10%, medium at 8%, and low at 7%, and get a future CAGR of 8.33%, which I think is fair enough. After that, I will base this on the 5-year average EPS of 2.10 and get an intrinsic value of $36.09, which is 61.59% lower than the current trading price. For the second valuation model, we will look to the multiples valuation, where I will compare Walmart to 4 of its competitors: Target, Costco, Dollar General, and BJ's. We will take these companies' current PE ratios and average them out to an average PE of 28.60. I will then multiply this by the current EPS of Walmart sitting at 2.41 and get an intrinsic value of $68.94, again lower than the current trading price. For the third valuation model, we will jump to the discounted cash flow model, where I will take the free cash flow from 2024 and based off of that, calculate the future free cash flow using a future CAGR of 5.7%. I will then discount all of this future free cash flow at a rate of 7% and get an intrinsic value of $45.91. And finally, moving to the dividend discount model, I will take the dividend payouts over the past 5 years and calculate the future dividend CAGR of 4.67% and still get a low intrinsic value of only $42.17. So jumping to the ultimate valuation, we will average out the 4 valuations and get an ultimate intrinsic value of $48.28, which is almost 50% lower than the current trading price. And therefore I rate the company as a strong sell. Even though I like Walmart as a business, with their innovation, stable financial and dividend growth, in my eyes they have become extremely overvalued, and with their current low financial growth, will their real value never be able to catch up with their stock price, increasing the risk of a large stock price decline. Therefore, again, I have to rate the company as a strong sell. And with that, I hope that you enjoyed the video. If you want to download these spreadsheets for your own personal use, the link is in the description. With that, make sure to leave a like and subscribe as it really helps me out.